Hey guys, welcome to this week's edition of the Swyftx Squawk. I'm Pav, lead market analyst here at Swyftx, and in this week's edition of the Weekly Insights, we're going to dive into how some of the spot ETF flows are looking and some of the more macro trends that I'm seeing moving forward, particularly after we've had our coverage of what the Fed is looking at with the new Fed chair there now in place. Now, let's kick things off by having a look at the Bitcoin ETF flows. Now, we're currently sitting at more outflows for the month of June than we did see in May. And when we add these 2 months up together, we're getting close to about $5 billion of Bitcoin sold off in net in the last 60 days. And obviously the month hasn't closed yet for June. There are still some days to go. So it'd be interesting to see how we close up here. But so far it's looking a little worse for wear than where we were back in May. And we're definitely seeing this projected in price. We're down 17% for the month when we look at a chart of Bitcoin as well. I've been thinking, while we're obviously seeing the market go down, the same way as if the market was going up, it's generally a trend that gets to a point where we do see some sort of reversal. And while we don't know when that reversal could happen, we can look at what are potential markers in the market that could act as a circuit breaker, right? What could potentially help drive the sentiment back the other way for the market? Reasons for the market to get back into a position where it's desirable to hold an asset like Bitcoin, right? And historically, we have seen that when policy pivots. And this is, again, a nice continuation from last week with the new Fed chair taking his seat and making his statement known to the public. So this week, we're talking all about inflation and some pretty interesting trends. Now, here's a headline metric that everyone watches. It's the US year-on-year inflation. Now, again, we're talking the US market here, because again, we're talking about the impacts this might have on US policymakers and the fact that the US is the largest consumer base on the planet. Now, we can see that since the rate rises that we saw in 2022, we had seen inflation come down from its 9% yearly figure to where it almost got home to that magical 2% number that policymakers are really interested in seeing. That was until the start of 2026 when we did see this almost double. Now, makes you think what's changed in this whole period between here and here. That's what we're talking about in this particular week at the Squawk. While we have seen tensions rise in the Middle East, there have been additional pressures on supply lines, as well as commodities like oil, which feed into our everyday living. It impacts transport, impacts energy production, and the ability to be productive at the end of the day. And when we look at a metric like inflation, it's an index, and an index is a basket of metrics that push together to build basically one number. And that's what you see right here, right? It's just 4%. To a degree, to a lot of people, it doesn't mean anything, but when you actually lift the hood on it, it probably helps everyone understand it a little bit better as to what actually drives inflation. And that's where I've got this little chart that I've built using Fed data, the headline components in the year-on-year inflation metric. And what you can see here is that over time, if we look since 2024, a lot of metrics have been actually deflationary or coming down. The overall trend has been lower, which marries up very nicely to obviously what we've seen here, right? It has come down objectively. But when we're trying to understand, well, what caused this little run up in inflation, it's right here. It's all in energy, it's all in transportation. It's all a very out of the ordinary impulsive drive higher, right? Like it's something outside of what you consider normal. Because inflation, the energy component of inflation had been coming down quite a lot to where it now sits. Now, the other important part of this all is this basket of goods that builds up inflation. There is a weighting to it as well. And energy and shelter, they make up a majority of the weighting as well. To see energy have a blowout, there's no other way to put it, it really puts a skew on the overall year-on-year inflation rate. Now, this is where this all comes together and gets really interesting. Inflation is a key metric that policymakers are looking at to make decisions as to what is the state of the economy. Do we need to potentially look to provide stimulus or ease conditions? Because if inflation comes down too much, you then put in risks like growth scares, jobs are potentially on the line as well, as people are basically finding it's harder and harder to see growth. So that's the key thing here to think about when we think about why does this matter? It's because it's going to drive policy in the future. The same way back in 2022, we saw inflation get almost close to 10%. That was what prompted policymakers to start increasing interest rates as one mechanism, just to try and basically curb spending and get money out of the economy. Obviously a very unique period in time. We're not saying this is going to be the same thing that we see again, but when we do see potentially inflation start to cool down enough, we then saw policymakers start to reduce interest rates. Now, interest rates is just one tool, but again, the emphasis is that there's more of a move to try and stimulate growth rather than continue to stifle it or put pressure on it, which is what we saw during this 2022 2023 period, which was also when we saw the bear market for things like crypto. Money was just less available in the system. So really all it comes down to is understanding, okay, we know that for a fact that one of the main pressures in the market right now is energy. Energy is oil. Oil is productivity for everyone. There's obviously a lot of noise still happening in this space. We're nowhere near a political sort of outlet here to try and tell you what's going to happen next. But watching what unfolds over the next couple of weeks, couple of months, is likely going to impact with high certainty what's going to happen to this energy component in inflation. And that's going to drive policy in the future as well as we head into the back end of 2026. And even just most recently, if we look at the price of oil and energy, while the headline figures for inflation, they have been rising quite dramatically in May. The price of oil has now come down from 110 down to somewhere $74 a barrel. A 22% drop in the price of oil as well. So you've got to start thinking about it from that lens as well, in my opinion, as to where things are likely going to go next. It could go lower, could go higher, but what we do know is that it has come down 20-odd%, but we still haven't seen a reduction in the headline inflation number as well. Could there be a bit of a lead, a bit of a lag effect there? That's what I'm looking to understand coming into the weeks and months ahead, like I mentioned. But that's it from me. I hope you found that interesting. Something, I guess, a little bit more optimistic to look at in terms of the way the market's moving. But at the same time, if we do see potentially a bit of a hesitation or escalation, this may take a little bit longer to play out as well. So it's not a guarantee by any means. Thanks very much, guys. Catch you next time.